Hey there! You ever hear about people who make money while they sleep and think, yeah, okay, but like, how though? Let me introduce you to John. John doesn't have a side hustle. He doesn't sell anything online. He's not flipping sneakers, day trading, or running a crypto Discord group. John just exists, and money keeps showing up in his bank account. No, he's not scamming anyone. And he's not secretly a prince from a small oil-rich island. John's rich because he figured out the ultimate financial life hack: dividend stocks. Now I know, dividend sounds like a boring finance term that lives in the same neighborhood as mutual fund and bond yield. But don't let the sleepy name fool you. Dividend stocks are basically like owning a chicken that lays eggs every month and then turns into a roast dinner after 30 years. Let's break it down. John owns shares in companies that pay out dividends. These are usually boring, stable companies, like phone companies, banks, or that one energy company that's been around since dinosaurs used fossil fuel literally. These companies make money, and instead of hoarding all the profits or spending it on a Super Bowl commercial featuring a talking goat, they say, hey shareholders, thanks for believing in us. Here's a little slice of the profits. That slice? That's your dividend. It's real cash. Not points, not store credit, not exposure. Actual money that gets deposited in John's account every quarter, or even every month. Let's say John owns 1,000 shares of a company called Boring Bank Inc. Each share pays 50 cents per quarter in dividends. That's $500 4 times a year, so $2,000 per year, just for owning the shares. John doesn't have to clock in, he doesn't have to post on social media, he doesn't even have to be awake. And the best part? He still owns the shares. They're sitting in his account like a money tree, gently showering him in passive income. But John's not done. You see, John isn't out here spending those dividends on fancy lattes and novelty socks. He reinvests them. Every time he gets paid, he uses that money to buy more shares, which means more dividends, which buys more shares, which pays more dividends. And the cycle continues. This is called DRIP, Dividend Reinvestment Plan. It sounds like a rapper name, but it's really just compound interest wearing a tie. Imagine planting one apple tree. That tree gives you seeds. You plant the seeds. They grow into more trees. Soon you're not just eating apples, you're running an orchard. That's John's life. Now let's rewind 10 years. Back then, John wasn't rich. He was just a dude with a regular job and a simple plan. Every month, he took a chunk of his paycheck and bought dividend stocks. No gambling. No trying to time the market. Just consistent, boring, automated investing in solid companies. And people laughed. They were like, John, bro, why are you buying old man stocks? Tesla just split again. But John smiled, nodded, and went back to his spreadsheet. Flash forward to now. John's portfolio is paying him more per year than his old job did. And guess what? The companies he invested in, their stock prices went up too. So not only is he getting paid every quarter, his wealth is growing at the same time. Dividends plus growth, rich and relaxed, John. Now let's bring in Kate. Kate used to chase the latest trends, crypto, meme stocks, NFTs, the whole roller coaster. One year she made $8,000. The next year she lost $12,000 and bought a pixelated penguin with sunglasses that's now. Then she met John. Not romantically, calm down. They were co-workers, sharing a break room and financial trauma stories. Kate saw how chill John was about money. He wasn't flashy, but he had peace, freedom, options. So Kate started asking questions, and John gave her the simple formula. Pick reliable dividend-paying companies. Reinvest every payout. Be patient. Don't panic. Kate gave it a shot. She set up auto investments every month, same amount, same time, like a subscription to her future self. 5 years in, she's getting regular dividend checks. She's not rich yet, but the seeds are growing, and she's sleeping better than she ever did with her limited edition blockchain duck. Now here's the twist. Dividend stocks aren't flashy. They don't go viral. They don't come with hype videos or celebrity endorsements. But they work. Because while everyone else is sprinting around trying to double their money overnight, John and Kate are letting their money work for them. It's the financial version of plant it and chill. Let's do some quick math. Suppose you invest $1,000 in a stock with a 4% dividend yield. That means you earn $40 a year in dividends. Not crazy, right? But you reinvest that $40. Next year, You earn dividends on $1,040, then on $1,125, and it starts to snowball. Now let's say you invest $500 a month in a portfolio, averaging a 4% yield, reinvested over 20 years. You don't even touch it. You'd end up with around $180,000, and it's paying you over $7,000 a year in passive income. That's every year for doing nothing but staying the course. Push it to 30 years, that income could be $20,000 a year. Keep going and reinvesting? You're now John, except maybe your chicken lays golden eggs. Here's the kicker. You don't have to be a stock-picking genius. There are ETFs like SCHD, VYM, or HDV that bundle a bunch of high-quality dividend-paying stocks for you. They handle the hard stuff. You just show up with consistency and a little patience. And no, this doesn't mean you'll become a millionaire overnight. That's not the point. The point is freedom. Predictable income, less stress, more peace. Because while the world argues over crypto and meme stock volatility, dividend investors are sipping tea and watching their money quietly multiply. That's why it's called the lazy way to get rich. Not because you don't do anything, but because once you set it up, you kind of don't have to do much else. You just keep planting and let the orchard grow. And the thing about orchards, they don't care if the market freaks out. They keep growing. When there's a recession, most people start panic selling, doomsday Googling, and hiding cash in places like sock drawers and behind the fridge. John? He just shrugs and says, well, I guess my dividends are buying even more shares now. Because during market dips, prices drop, but dividend yields often go up. Let's say your favorite dividend stock is usually $100 and pays $4 per year. That's a 4% yield. Now the stock dips to $80 because the market's having a meltdown. But they still pay $4? Now that's a 5% yield. Same company, same payout, just cheaper stock. John calls that a sale. Bob from earlier, he calls it a crisis. This is why dividend investors aren't glued to market news like it's a suspense drama. They're not playing the guessing game, they're just stacking cash flow. They've made peace with volatility because their income doesn't depend on stock prices going up. It depends on companies continuing to pay. And most dividend-paying companies are built for stability. We're talking Coca-Cola, Johnson & Johnson, Procter & Gamble. These are companies that survive wars, pandemics, and the occasional CEO with a yacht obsession. They sell toothpaste, soda, toilet paper. Not exactly the kind of stuff people stop buying during a recession, which means their profits are reliable, which means their dividends are reliable, which means your income is reliable. Now let's talk taxes, because yes, Uncle Sam always shows up at the barbecue. But dividend income in many countries like the US and Canada gets special tax treatment. In the US, qualified dividends are often taxed at a lower rate than regular income, which means John, who's earning $20K a year in dividends, might be paying less tax than someone earning $20K from a part-time job. He's getting paid more and taxed less for doing nothing. That's when people start asking, wait, is this legal? Yes, it's just not widely taught. Most people are told to get a job, work hard, save, and hope their 401k doesn't explode. John and Kate, they're letting companies pay them just for owning stuff. And here's something even wilder. Let's say John builds his dividend income up to $4,000 a month. At that point, he's basically retired, even if he's still in his 30s. He could live off that, or work less, or take risks on things he actually enjoys. Dividend income gives you choices, and choices equals freedom. That's the true power of this strategy. It's not about Lamborghinis, it's about being able to go for a walk at 2 p.m. on a Tuesday and not having to explain it to anyone. And that's the vibe. You don't need to own 10 properties or build the next billion-dollar app. You just need to consistently buy small slices of companies that reward you for showing up. Let the dividends compound. Reinvest. Ignore the noise and give it time. You'll wake up one day and realize you're not working for money anymore. Money's working for you, and you got there by being just a little boring. And that's the best-kept secret of wealthy people. Boring money is powerful money. It doesn't go viral, it doesn't crash overnight, it doesn't have a theme song or a hype squad, but it shows up every single month. John knows this, Kate's learning it, and now, so do you. So in conclusion, dividend stocks are the lazy way to get rich, not because they require zero effort, but because they work while you don't. You invest in companies that pay you to own them. You reinvest the money they send you. You do it consistently, and you wait. No burnout, no drama, just slow, steady, reliable growth, and the beautiful realization that wealth doesn't always come from hustle. Sometimes it comes from holding. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.